Hey, my name is Connor, and welcome to Crypto Empire, where we dominate the crypto markets. This video is an 8-lesson step-by-step course on how to greatly increase your chances of making money in the cryptocurrency markets. After you watch this video, it should take you from a beginner to somebody that can hold his or her own in the crypto markets. Now, with that being said, obviously, you're going to have to put in the time yourself. This video alone will not get you there. However, it is filled with valuable information and strategies from a seasoned cryptocurrency trader. That's myself. So if you're just getting into crypto and you want to learn how to trade from start to finish, how to interpret the data, how to read the charts, how to place the orders, how to know the different order types, and overall how to profit from cryptocurrency, well then this is the video for you. All the resources, links, and timestamps are down in the description below, so feel free to make use of those. And without further ado, let's get right into it. I hope that you enjoy this video. I hope that you get a ton of value from it. And like always, let the gains be with you. So this is Crypto Empire Beginner Trading 101 presented by yours truly, Connor from Crypto Empire. And after you watch this video in full, it should take you from beginner to intermediate. Like I said in the intro of this video, it will help you hold your own in the crypto markets. There is no skipping the experience from actually trading on your own to learn how to trade. You're still going to have to put in that time, effort, and work to get to where you want to go, but this resource will greatly accelerate your learning process. So let's get right into today's lesson plan with that being said. And before we do go on, I would greatly appreciate it if you do go down below and like the video, as well as subscribe to Crypto Empire and also turn on all bell notifications so you don't miss any future videos. So today's lesson plan, what's on the agenda? So the first lesson, Cryptocurrency 101. What is crypto? Is crypto risky? What's the point of cryptocurrency? Is it just magic internet money, or is it serving some kind of bigger purpose in the world right now? We're going to be talking about that. Lesson number 2, cryptocurrency trading. The use case of stablecoins. Stablecoins are very, very essential at this moment in time for liquidity in the markets. We're going to be talking about that. Also, what are trading pairs? What is the base and quote currency? You need to know this when you're on the exchange. You need to know what the base and quote currencies are. We're going to be talking about that and how to interpret the trading data so that you can make informed decisions. After that, we're going to be talking about the best crypto news and info sites, best places to learn about crypto, as well as some crypto research secrets that will help you discover some very, very important information and maybe the next 100x altcoin gem. Never know. After that, we're going to be talking about the cryptocurrency trading exchanges, the best places to analyze the charts, best crypto trading exchanges for both beginner and advanced traders, as well as exchange fees and how to go about picking the exchange that you are going to use. I will help you figure that out. After that, lesson number 5, exchange options, centralized or decentralized exchange. So centralized exchange, otherwise known as a CEX, or a DEX is a decentralized exchange. So decentralized exchanges are brand new. We're going to be talking about what they actually are, what is a token swap, as well as what you should be using as a trader. Next lesson is cryptocurrency trading strategies. We're going to be discussing day trading versus swing trading, what might be best for you, how to trade breakouts, the difference between day trading, swing trading, as well as investment trading, how to use all those strategies to profit, and of course, how to dollar cost average, which is a very foolproof method of accumulating great wealth in crypto. Now, I will say right now, this course, this video is in no way a guarantee that you will make any profit in crypto at all, but I will be teaching strategies that I do use personally. After that, trading order types. We're going to be talking about the market and limit orders, what they actually are, stop market and stop limit orders. You need to know all the different order types and how to actually use them, because every trader uses all the different order types depending on the situation. So we will be discussing that in detail, as well as the bid-ask spread. You need to know what the bid-ask spread is so you don't get wrecked. And then how to use each order type like I just said. After that, we're going to be talking about the technicals. So this is lesson number 7 right here. How to identify the trend, supply and demand, support and resistance, as well as candlestick chart patterns. You guys know I love my supply and demand zones with the Fibonacci price retracement tool, and I also do love my W reversal patterns as well as the ascending triangle chart pattern in a bull market, which we are in right now. So this is going to be a very, very important lesson, technical analysis in crypto. After that, lesson number 8, we're going to be talking about some trading examples. We're going to be jumping into the charts, into the exchanges, and we're going to actually be trading. So I'll teach you how to scan the market for opportunities, proper risk management. You need risk management. That is one of the pillars of being a profitable cryptocurrency trader. I'm going to teach you how to take a position in the market and how to set your stop losses at correct price levels so that you are protected, you are managing your risk at all moments of time. And then we're going to summarize everything up. So this is where to start if you're new to trading. I'll be sharing again the top resources I use, and I'll be discussing the risks again in cryptocurrency trading. So very excited. I hope you are as well. All right, now moving on. Who am I? A little bit of a teacher introduction. So my name is Connor from Crypto Empire. You already know that. But I am also a college dropout turned profitable cryptocurrency trader. I went to college, university for 2 years straight. At the start of my 3rd year, I decided enough was enough. I dropped out and I sought alternative education that would essentially help me reach my goals instead of going to a traditional university. So I'm very grateful that I did make that decision because it led me to the world of trading. So I do have 4 years of trading and investing experience in the financial markets. I started off in the futures markets, trading commodities such as gold, silver, crude oil, as well as the indices like the ES, the YM, the NQ. And then I went full time into cryptocurrency because I realized that that is where the opportunity truly lies at this moment in time. And I'm also a world traveler. I did travel the world for 2 years straight. I got back to the US about 1 year ago. So all of that experience, looking at how the world actually works, seeing different cultures, it definitely helps me out as a trader with psychology because trading is a lot of psychology. So everything comes full circle, everything helps bake that cake, and now I am able to convey all this knowledge that I have picked up throughout the years to help you out on your own journey, and I am very grateful for that. Now, before we do actually start up lesson number 1, I do have to say that I am not a financial advisor, and this video is not financial advice. This video is for educational purposes only. You need to know that trading involves risk of losing all of your capital. Trade at your own risk. Now, with that out of the way, let's get into lesson number 1. Cryptocurrency 101. We're going to be talking about what is crypto, the different types of blockchains, the different types of cryptocurrency, as well as what are tokenomics. You're going to hear that word a lot, tokenomics. It's very important you understand what it is and how to actually interpret a project's or a cryptocurrency's tokenomics. Cryptocurrency is a tokenized asset that has value. It is not magic internet money. Crypto has real value. It can be used as a legal tender now in El Salvador, meaning it can be used in any shop. So crypto is very real and it will eat the entire financial system that we know today. So every cryptocurrency is different. They're not all made the same. They are not all created equally. So crypto is very easy onboarding for trading. Once you do actually turn your fiat into crypto, it's very easy to trade. Once you do actually onboard your fiat and turn it into cryptocurrency, that is. After that, crypto has borderless transactions. No more dealing with banks, right? It's all on the internet, all on the blockchain, and the middleman is completely cut out. It is revolutionizing the financial system. Also, crypto has 24/7 trading hours. The market never sleeps. It is not like the New York Stock Exchange where it opens in the morning and closes at night. Those days are days of the past. Also, crypto is mainly used as an investment vehicle to store your wealth, right? That is the main narrative going on for Bitcoin. It's a store of wealth, a hedge against inflation. But we're going to be discussing all of the different types of crypto as well. So the types of blockchains. So there are different kinds of blockchains, and if we go on CoinGecko really quick, not all of these cryptos are actual blockchains. Some of them are built on top of blockchains, and you'll be able to understand what I mean by that after this lesson. So there are the currency blockchains, the cryptos that are used for actual currency and not a protocol or a specific use case cryptocurrency. So the currency blockchains include Bitcoin, Monero, which is basically private anonymous Bitcoin. We also have Pirate Chain, another privacy coin, Litecoin, Bitcoin Cash, Zcash, Dogecoin, and then stable coins as well are currency, but stable coins are built on top of a blockchain. For example, USDT was originally built on top of the Ethereum blockchain. USDT is 1-for-1 for the US dollar. It's a stable coin. So the types of blockchains continue. The smart contract blockchains. So smart contracts are increasingly becoming the most popular types of blockchains because they allow for increased functionality. You can build smart contract decentralized applications on top of these. So these blockchains include Ethereum, Polkadot, Kusama, Cardano, Binance Coin, the Binance Smart Chain, Solana, Terra Luna, Avalanche, Tron, and there are many, many more. And staking is available for these proof of stake smart contract blockchains. Staking basically means passive income for you. The types of cryptocurrencies continued. So they all have different value propositions, like I was saying. There are the currency coins, there are the privacy coins, there are the protocol tokens, the exchange tokens, the DeFi tokens, utility tokens, stock tokens, meaning they represent stocks 1-for-1 and you can trade those on the blockchain. NFTs, non-fungible tokens. These are all the craze right now, selling for hundreds of thousands to millions of dollars. This is a picture of some NFTs right here. And then, of course, there are the garbage coins, the scams. Crypto is the wild, wild west, so you need to know what you are buying or selling before you do press that buy or sell button, because there are a lot of people out there out to get the crypto in your wallet, and they're very clever with their scams in the form of garbage coins. Next, tokenomics. So, like I said, not all cryptos are created equal. The dollar value of the cryptocurrency is different for all of them. The supply of the cryptocurrencies are all different. They all have different levels of supply, maximum supply, circulating supply. For example, I'll show you right now. Bitcoin is the most obvious example because it is one of the most scarce cryptocurrencies. It has a max supply of 21 million and a circulating supply of 18.8 million Bitcoins. So a lot of the cryptos that you'll see on the market will have hundreds of millions to billions of coins and tokens in circulation. Bitcoin, extremely scarce with 21 million, has great tokenomics. Also, they all have different market caps. So you can see the market caps. This site, by the way, is coingecko.com. It is one of my favorite cryptocurrency resources. Highly recommend you make an account, free to do that, and you get comfortable with this site. So CoinMarketCap and CoinGecko, they show you the coins in order of market cap. So market cap is definitely a big metric that we use to judge whether an investment is good or not, and we can make profit from it. And then as well, the number of coin holders, very important. If a coin has a burning mechanism, meaning it decreases the supply over time, that's another tokenomics value to take into account. And then as well, the crypto ICOs, initial coin offerings, and initial DAO offerings, IDOs. So you need to know what those are and what the tokenomics entail for those as well when they are actually launching. So here we have PokeX tokenomics. This is a Polkadot project that will be launching very soon on the Shiden network. And I do have an image of the tokenomics because this was basically offered as like an early pre-sale type of thing. So the tokenomics, this outlines how tokens are distributed to the investors. So the token distribution greatly affects how price does perform, and each project is different, and this can be found in the documents of each individual project. So here we can see the PokeX token distribution. 5% is going to the private A round, 6% going to private B, 1% to the IDO, 13% to the team, 10% to the developers, 10% to the marketing and operators, 8% liquidity, 10% to the community incentives and airdrops, 15% farming, 2% advisors, and 20% to the treasury. So that is how the PokeX token will be distributed after it does have its token generation event, TGE. But nonetheless, that is a little bit about tokenomics. You will get more familiar with tokenomics as you do go on your cryptocurrency journey. But to sum everything up, it is the value, the supply, the volume of it traded, the amount of money, the market cap overall, the number of holders. These all encompass the tokenomics of a project. So let's summarize lesson number 1. That was a quick one. So cryptocurrency is a tokenized asset on a blockchain, right? Very simple. There are different types of blockchains and tokens for each different purpose. NFTs are one for one. They are non-fungible. So I'll give an example. Let's take into account a dollar bill. Let's say I were to give you a dollar bill and you went and spent it on anything. You went and spent it on a candy bar. Cost $1. The next day, you come back and you repay me a different dollar bill, and I gladly accept it because the value is $1. That bill represents $1 regardless. But with a non-fungible token, they are one-off, meaning they are non-fungible. If I give you an NFT and then you go and you lose that NFT and you come back the next day and you say, hey Connor, I got your NFT here, and I look at it and I say, this isn't my NFT. It's not the same. Where did the original go? That is because it is non-fungible. It cannot be replaced. It cannot be duplicated. So that is what gives NFTs so much value. So most cryptos are actually fungible, meaning you can exchange them one for one. I can give you one Monero. You can go and spend it somewhere, and then you can send me another Monero from wherever else, and I would take it because one Monero is one Monero. Next, each coin/token has a different value proposition. They all serve a different purpose. Also, the tokenomics and token distribution varies project to project. So you need to learn how to actually understand the tokenomics and know if you're about to invest into a project that has very sound tokenomics or one that gives off kind of scam vibes. You want to stay away from those. All right, so the best crypto info and news sites, these will be down in the description of this video below. But CoinGecko and CoinMarketCap really serve the same purpose. They give you prices, market cap data, very, very useful. You can track your entire portfolio, set that up if you do make an account, which is free to do. So I highly recommend, I like CoinGecko better, I like the data better. CoinMarketCap works as well. For news, we have Cointelegraph and CoinDesk, as well as Decrypt. So these are all news sites for cryptocurrency. Links will be down in the description below, pretty much like the main headline news sites for crypto. And then academy.binance.com is an amazing resource to learn about crypto. They cover pretty much everything under the sun when it comes to cryptocurrency over at academy.binance.com. If you want to learn anything, any questions about a very specific thing, I'm sure it will be answered over there. So bookmark that page and make use of it. It is very, very useful. All right, now moving on, let's talk about cryptocurrency trading, lesson number 2. So the basics of crypto trading, the use cases of stablecoins. You need to understand what stablecoins are used for, currency pairs, base and quote currency explained, as well as how to interpret trading data. All right, let's start things off. What is a stablecoin? So a stablecoin is a tokenized version of fiat currency. It's literally the crypto version of a dollar bill. There are many different kinds of stablecoins. As you can see, this is Tether. This is like the original stablecoin. This is USDC, US dollar coin. This is UST on the Terra blockchain, and then there's Binance USD. So all of these different stablecoins represent $1. So stablecoins are backed by real-world assets such as money in the bank, precious metals, commodities. Anything that holds value can back the value of a stablecoin treasury. So price is pegged 1-to-1 to that asset, to the dollar, and stablecoins are absolutely imperative for liquidity on exchanges and often the gateway into crypto. So at this moment in time, billions of dollars of crypto are traded every single day, and there needs to be sufficient liquidity, and stablecoins really allow for that sufficient liquidity to enable a smooth trading experience with low slippage for traders around the world. So stablecoins are super important, especially for exchanges. And we have examples right here, USDT, UST, USDC, as well as Binance US dollar, all represent $1. All right, moving on. What is a currency pair? So you can only trade cryptos in pairs, right? You're always going to be buying one crypto and selling another one that you hold to buy it. So you sell one asset to purchase another asset. This process is done in an exchange. For example, we do have Bitcoin, BTC, USDT, and then there's Ethereum, BTC. So I can give you an example of what that actually does look like on the exchange. So here is BTC, USDC. We see that in the top left corner here. And if we click on that, we can see all of the different trading pairs that do actually pop up with Bitcoin, right? All these different altcoins can be traded against BTC Bitcoin. So that is a currency pair. Very important that you need to understand that you're buying one crypto and selling another simultaneously every time you make a trade. After that, let's talk about the base versus quote currency. So the base currency appears first, and this is what you are buying. For example, BTC USDT. If you go to buy this, you are buying Bitcoin and you are selling USDT. The quote currency appears second, and this is what you are selling. The base currency is what you buy, and the quote tells you how much you need to buy a single unit of the base currency, right? So on the exchange, we see BTC USDT, and the current market price, the quote price, is $48,300. It's constantly moving. We're going to be getting into that later on. But basically, $48,300 is how much one Bitcoin costs in USDT. So that is the base versus quote currency. Here's an example, BTC USDT, $45,000. That means one Bitcoin costs 45 grand. So if Bitcoin moves 5%, then the new quote will appear as $47,250, right? We see 5% moves all the time in the markets. So that is basically the base versus quote currency. You are buying the base currency and you are selling the quote currency every time that you make a trade. That's how it works. It's very simple. After that, trading pairs on altcoins. So not all cryptocurrencies have trading pairs with each other. You're going to learn that. For example, Polkadot and Cosmos, they don't necessarily have a trading pair. So that is when stablecoins like USDT come into play. So smaller altcoins will not have trading pairs besides Bitcoin and USDT, right? So Litecoin and Polkadot, that pair doesn't exist. You can't just go ahead and buy Litecoin by selling your Polkadot. You're first going to need to sell your DOT into USDT or Bitcoin and then use that to buy the Litecoin. So like I said, first trade USDT, then DOT. And this can be referred to as a cross trade. All right, let's give a trading example. So let's say you invest $10,000 into Polkadot and Ethereum at $5,000 each. Right? You put $5 grand into each of them. Both of them increase in price. Let's say Polkadot goes up by 30%, meaning that $5,000 turns into $6,500. And then let's say Ethereum goes up 20% after you buy it, so you turn that $5 grand into $6 grand. So this tells you that you made a total profit of $2,500, right? And if you had just invested that money into Polkadot, well, then you would have had $13,000. So diversification isn't always the best route to take because coins will outperform one another. But with that being said, it's very hard to pick the ones that will be the really big winners. So diversification, like I said, it does have its pros and its cons. You're not going to essentially make all the profit, but it will help you minimize your losses if one of your coins that you do invest in end up being a sour investment. So diversification has its pros and cons. I definitely suggest diversifying in crypto. I have a few videos on how to set up a portfolio, but nonetheless, that example shows you that sometimes you can just make more money by going all in into one coin. That's not financial advice. All right, next up, another trading example. So let's say you're taking a bet that a particular crypto will outperform the other ones. When you purchase the crypto with fiat, you are betting that the crypto you purchased will perform better than the fiat currency that you did use to buy it. This is trading in the most simple form there is. Crypto versus fiat, right? When you buy Bitcoin, you are selling the dollar. You're shorting the dollar essentially if you do go ahead and buy Bitcoin. That is trading in a nutshell on the very most simple, pure form level. I hope it makes sense. If you have any questions, of course, leave them down in the comment section below. All right, let's summarize lesson 2 now. So stablecoins are 100% necessary for trading in the cryptocurrency markets, right? We need them for liquidity. We need them to cross trade because a lot of altcoins don't have direct pairs with one another. So we need stablecoins. And currencies can only be traded in pairs. You're always going to be selling one asset to buy another asset. You need to know the difference between the base versus the quote currency, right? What you're buying, what you're selling. And when you buy or sell crypto for fiat, you are betting that one asset will perform better than the other asset. I gave the example. When you buy Bitcoin and you buy it with dollars from your bank account, you're betting that Bitcoin will do better than the US dollar, which in my opinion is a very, very smart bet to take given the hyperinflation we're seeing globally at the moment. But nonetheless, that is basically what you're doing, right? You're selling fiat and you're buying crypto with the intent that your crypto will do better than your fiat. All right, let's move on now to lesson number 3. The different crypto trading exchanges. So there are a lot of exchanges out there, and as a beginner trader, you need to know which one is best for you, which one offers you the most products, the most opportunities, and has the lowest fees as well as the most beginner-friendly ones. So the best place to analyze the crypto charts, we're going to be talking about the best crypto trading exchanges for both beginners and advanced traders, as well as the fees and how to actually go about picking your exchange. All right, let's start off talking about Coinbase. So Coinbase, probably one of the most popular exchanges in the world, as well as the most beginner-friendly exchange in my opinion. So Coinbase does have Coinbase and Coinbase Pro. The Pro version is for advanced trading features. Basically, it allows you to trade currency pairs, whereas the regular Coinbase, literally you just buy crypto from your bank account and then you can exchange that for another one, but there's no advanced features at all with the regular Coinbase. So Coinbase does have high fees ranging from 2 to 3%. So that is pretty significant. And then the Coinbase Pro fees are 0.5%. Does offer staking and opportunities to earn yield on your crypto if you hold them in your Coinbase account. Coinbase does not have any leveraged trading, all right? So if you're a leveraged trader, then you can't use Coinbase. Staking isn't really good at all, right? The yields are low, and yeah, it's just low payouts really compared to many other options. I have a lot of option staking tutorials on the channel. Definitely check those out if you want to learn more about staking, but Coinbase, not the place to stake. So like I said, Coinbase is great for beginners or taking your money and either turning fiat into crypto or crypto back into fiat that would go into your bank account and you can spend in the real world. And full know your customer is required for Coinbase. You can't get around that with Coinbase. Next up, we have Binance. So Binance by far is the world's most well-known and popular cryptocurrency exchange. Binance does have a regular version as well as a US version. Because of the US jurisdictions, you actually can't use the regular version. So it's a completely different company, Binance.us, and it's not nearly as good as the regular Binance that everybody else can use, but nonetheless, it's there for you. So Binance is a full suite cryptocurrency exchange. It has a ton of altcoins to choose and select from, right? Altcoins really like fight and battle and push really hard to get listed on Binance because it is the most popular exchange. So Binance is good for beginners and advanced traders. It has great staking support. They pay out high yields and give you a lot of options to stake your coins. So Binance also has very low fees. We're talking 0.075%. It's the largest exchange in the world. It has a ton of liquidity, right? Not a lot of slippage unless you're trading a really low cap altcoin. And there is KYC required at this moment in time. This is like brand new that Binance is requiring KYC, so it is what it is. Next up, we have FTX. I'm really a big fan of FTX. It has FTX or FTX.us. This is an advanced platform. It has a great selection of altcoins. Now, the FTX.us version, as well as the Binance.us version, these have a very limited selection of altcoins, which it is what it is. We can't do anything about it. But FTX.us is a great way to onboard your fiat into crypto just like Coinbase, and it has a lot more features and a lot lower fees. So I really like FTX.us if you're in the US. So great staking support as well on FTX, high yields, good payouts. FTX, the regular version for everybody else in the world, not in the US, is one of the world's largest exchanges. It is extremely popular, has a great team, great management behind it. Low fees, lower than Binance at 0.07%, and it does have great customer support as well. Next up, we have KuCoin, which is a favorite of mine. So KuCoin is another full suite crypto exchange. It has a lot of really, really good altcoins that are, a lot of them are exclusive to KuCoin. So a lot of KuCoin gems, we call them, on KuCoin. There is a bit of a learning curve if you are a beginner. And KuCoin, again, has great staking options in their Pool X section of KuCoin, of your account. It does have compatibility with trading bots. There are very low fees again on KuCoin. We're talking 0.08%. One great thing about KuCoin is no KYC is required at all. It's available for US residents, but you can't actually link up your bank account and get money directly from your bank into KuCoin. You would need to use a service like FTX.us, Binance.us, Coinbase, and then send the crypto that you buy into your KuCoin account to utilize the KuCoin exchange. Now let's talk about the best exchanges. So I use really all of them. Of course, obviously not the ones I can't use like Binance and FTX, but nonetheless, I do use a healthy mix of really all of them. So for beginners, Coinbase you can't go wrong with. For the best altcoin selection, Binance and KuCoin for sure. Best staking, passive income, Binance and KuCoin. FTX is really good as well, but I put Binance and KuCoin here. Best mobile app, they're all great. KuCoin, FTX, Binance. Coinbase has a good mobile app, but you can't really trade on it. It's just good for really making swaps or just buying more crypto from your bank account. Lowest fees, FTX, then KuCoin and Binance. Top choice for US residents, I would recommend FTX.us and KuCoin, because you can link up your bank account, do ACH with FTX.us. You can take the crypto you buy, you can send it to any exchange, and it does have lower fees than Coinbase. So that is the best exchanges out there. Now check the video description down below, because the links to all of these exchanges are in the description, and I recommend that you start with 1 to 2 exchanges, and you're going to work your way into using all of them really once you get really into crypto. Like we are here at Crypto Empire, you're in the right place. And you can go ahead and click the link to sign up, and you do receive a bonus, and you do actually support me here at Crypto Empire as well if you do use the link. So I greatly appreciate it. All right, now let's summarize exchanges, everything we did just talk about. So exchanges are personal preference. They all serve really the same purpose, right? It's nothing crazy. You're buying and you're selling your crypto on the exchange, you're trading. They all serve the same exact purpose. FTX, KuCoin, and Binance are the best exchanges for traders. Simply put, they have the most liquidity, so you won't suffer from as much slippage. They have more indicators, more advanced trading features and interface. So if you are getting serious about trading, I recommend that you open up at least one account with one of these exchanges. Again, it's completely free to open up an account, but of course you need to fund it with crypto to trade. So you can use ACH to deposit funds for lower fees, right? That ACH basically is directly from your bank account to the exchange, usually using a third-party service such as Plaid. And then Coinbase is for fiat on-off and for beginners, right? You can't go wrong if you're just getting into crypto. Use Coinbase, whatever, you pay a little more fees, but it's just so easy to use, very beginner-friendly. They have a decent selection of altcoins, so yeah, you can't go wrong. Just make an account and get your feet wet. The sooner that you do start, the quicker you will become, or the further down the road you are to become a profitable cryptocurrency trader. So action speed is very important, not just with crypto, but with everything in your life. Moving on, lesson number 4, centralized versus decentralized exchanges. So decentralized exchanges are a bit of a new phenomenon. They really got popular with Uniswap back in 2020, and from there they really took fire. So DEX or CEX. What is a decentralized exchange? We're going to talk about that. We're going to be talking about the blockchain networks with the most popular decentralized exchanges. What are token swaps? What are liquidity pools? And then we're going to be talking about the widely used decentralized exchanges that you can trust, as well as the best option for you. So what is a decentralized exchange or a DEX, DEX? So DEX stands for decentralized exchange, runs on a blockchain as a decentralized application. It is a smart contract built on top of a blockchain. For example, this first image here is of Uniswap, and you can see that one WBTC wrapped Bitcoin is worth 13.7 Ethereum, and you can go ahead and you can swap that, change your wrapped Bitcoin into Ethereum right on Uniswap, and this is built on the Ethereum blockchain. Down here is TerraSwap, built on the Terra blockchain, and you can see that 1,000 Luna can be changed for 35,926 UST. UST is the algorithmic stablecoin on the Terra blockchain, and that is 1-to-1 to the US dollar UST. So a blockchain is a decentralized application. It's a smart contract. It runs off of code. Nobody controls it. So an exchange, a centralized exchange, a company literally has full control over your funds, over that exchange. They're running a business. A decentralized exchange, nobody controls it. It is computer programming, it is code. So a decentralized exchange allows you to swap tokens for each other. It's not necessarily a trade. You're literally swapping the tokens. DEXs do have low fees for swaps. We're talking 0.05%. You must use gas to pay for network fees when using a decentralized exchange. For example, on Ethereum, if you're using Uniswap, you're going to have to use your Ethereum, your Ether in your wallet to pay for the gas fees to execute the transaction. Same thing with TerraSwap. You're going to have to use your Luna to go ahead and pay for those transaction fees or gas. So some decentralized exchanges have low liquidity, and when a coin or a token pair does have low liquidity, you will suffer from slippage, and you want to avoid suffering from slippage because it can be pretty detrimental to your capital. And also, a decentralized exchange, a DEX, requires a cryptocurrency wallet, such as a browser extension like MetaMask, like TerraStation. You're going to need to get familiar with browser extension wallets. I show you how to set all those up in my tutorial videos. Go ahead and watch those after this video if you want to learn how to set up your own browser extension wallets to start interacting with these decentralized exchanges. So decentralized exchanges, there's no KYC whatsoever. It's anonymous. You're literally using your wallet address. That's your identification, your wallet address. There's no name, nothing tied to your transaction but your wallet address. All right, moving on. Blockchain networks with popular decentralized exchanges, popular DEXs. So the most popular ones include the smart contract blockchains, the layer 1s and the layer 2s. Ethereum does have Uniswap, SushiSwap, and 1inch as their main DEXs. The Binance Smart Chain has PancakeSwap. They also have Bakery Swap and Burger Swap, but really PancakeSwap is the main decentralized exchange on the Binance Smart Chain. Polkadot has PokaSwap and PokaX, as well as PokaDEX, but these really aren't even live yet. The Polkadot ecosystem is still growing, it's still in development, so be looking out for PokaSwap and PokaX. I do have videos on both of these projects if you want to learn more about them. Kusama does have Karura, which is the DeFi hub of Kusama. I have a full video about Karura. If you want to learn more about that project, it has a lot of potential, not financial advice. The Terra blockchain has TerraSwap. Solana has Serum and Radium. Avalanche has Joe. Zilliqa has ZilSwap. The Matic Polygon network has QuickSwap. So basically every single blockchain has their own decentralized exchange at this moment in time. You're going to really learn how to use all these once you get into crypto, but it's not that complicated. It's all going to make sense. All right, now what is a swap? So a swap is an interchange of one token for another. There's no middleman, 100% decentralized, no centralized party, no order books, none of that. Swaps do have low fees. We're talking 0.05%. And you're going to have to use your MetaMask for anything on the Ethereum blockchains, or really MetaMask supports most blockchains, or TerraStation if you want to use TerraSwap. TerraSwap will, in my opinion, become one of the most popular decentralized exchanges with the advancements of the whole entire Terra ecosystem. So, like I said, a decentralized exchange does not have an order book. They function off of liquidity pools. What this means is that individuals like you and I, anybody out there, can go ahead and they can add liquidity in a decentralized exchange. They are basically the market makers when they add liquidity. But a decentralized exchange is called an automated market maker. It automatically matches a buyer with a seller with the liquidity in the liquidity pool. So when you do provide liquidity, we're going to talk about that next. I'll talk about that next, actually. We'll go to the next slide. Swaps on decentralized exchanges, they have a very low barrier to entry. They have no requirements for users, and anyone can create a coin to list on a decentralized exchange. Right? So that's where we're talking about those garbage scam coins. Anybody can create a token, anybody can list it on Uniswap, run a marketing campaign, and get suckers to buy it and then cash out on all the people that do buy it. We call those rug pulls, exit scams. We see them actually quite often in crypto, so you need to always do your due diligence before you invest into any project, because it is the wild, wild west out here. And there's no barrier to entry, no KYC. Nobody knows who you are except for your blockchain wallet address. So what is a liquidity pool? Liquidity providers, or LPs, are individuals that provide their token as liquidity on a decentralized exchange. LPs earn a percentage of the trading fees on the pair they provide liquidity for. So I have an image here of Uniswap, the top liquidity pairs. And you can see the second pair is Wise Ethereum. So if you go ahead and you provide liquidity for Wise Ethereum, every time somebody trades either Wise for Ethereum or Ethereum for Wise, they're going to incur that 0.05% trading fee. Now, however much liquidity you do add to the pool, you will get your amount of that fee based off of the percentage of the pool that you do own with what you did provide. And when you provide, you're going to be providing an equal amount of Wise and Ethereum, the equal values of one another. It automatically sets that for you. So a liquidity pool is essentially a large collection of tokens that takes the place of a centralized order book. And these are automated market makers. The protocol automatically matches a buyer and a seller for a token swap. So we're living in the future now, right? We don't even need order books anymore. Although order books do serve their purpose. They're a little helpful for trading, especially if you are trading a very large sum of capital. So the pros and cons of decentralized exchanges. The pros, they are 100% decentralized. They are low cost, although that does depend on the blockchain. Of course, on Ethereum, you're going to have to incur that Ethereum gas fee, which at times can be crazy expensive. We're talking at times like over $100 to swap a $20 token for $20 of USDT. So depends on the blockchain. Binance Smart Chain and really all the other blockchains are lightning quick and super cheap. Ethereum is figuring everything out with Ethereum 2.0, hopefully rolling out in early 2021. That should solve the gas fee issues. So another pro of decentralized exchanges, access to small altcoins that aren't listed on the big exchanges yet, right? Newer projects that just came out, and some of them are quality and can make you a lot of money. Also, decentralized exchanges do offer passive income sources such as providing liquidity, and some offer staking like PancakeSwap. And it allows you to earn trading commissions instead of paying those commissions out to exchanges. So every time you use a centralized exchange, you pay trading fees, you pay commission for your trades. On a decentralized exchange, if you provide liquidity, you actually get paid that commission for providing that liquidity because you are the market maker in a sense. You're providing liquidity for the automated market maker to match the buyers and sellers together. The cons of decentralized exchanges. So your crypto must be kept safe in your own wallet. You are fully responsible. Of course, if you put your crypto on an exchange, the exchange is now the custodian of your crypto, meaning they do have full control over it. You do as well, but it's really their keys, their private keys. So another con of a DEX, rug pulls do happen often. A lot of garbage projects get listed and they're only after investors' money. They don't really care about anybody. Watch out for those. Do your own due diligence before you buy or sell any crypto. Another con of a DEX, no limit orders, right? It's only market orders. They are building out protocols, decentralized applications. They will offer limit orders on DEXs, and this is going to be huge when it comes out. So look out for those. I'll keep you updated. Subscribe to the channel so you know when that does actually come out for DEXs. Also, no charts. So you can use resources such as dextools.io. That's actually another amazing resource, Dex Tools. Highly recommend you get familiar with that. I'll show you it really quick. Basically, it allows you to see charts for all of the coins listed on Uniswap, PancakeSwap, QuickSwap on Matic. It allows you to see all of the coins. So we have Floki right now going crazy. And usually you can't necessarily see that pair, but Dex Tools makes it very easy to do so. It's a great resource. Get familiar with Dex Tools. Also, knowing how to use a decentralized exchange does require technical knowledge. It's not necessarily the easiest thing to do, especially if you're a beginner that has never used crypto or blockchain before. There's a learning curve to it. So keep that in mind, but once you learn, it's super simple. It's not that hard. So don't let me saying that scare you into using them. Very simple to use. I have tutorials on the channel that show you how to use them. You'll figure it out if you just apply yourself a little bit. All right, let's talk about a centralized exchange versus a decentralized exchange. So a centralized exchange, it's great for trading, especially trading lower time frames like a day trade. There's more data with the charts, the tools, and some of them also do have a calculator. That's very useful if you're going to use leverage. This video we're going to be focusing on spot. This is a beginner tutorial, right? But they do have a calculator that will help you calculate your risk, how much profit you would make if the trade is successful. There is more liquidity for trading on a centralized exchange. More beginner friendly, right? You can just make an account, start trading right away, just press the button, really. Pretty simple. And centralized exchanges do offer support if needed. With that being said though, not your keys, not your crypto. When you have your crypto in a centralized exchange, let's say something, they get hacked, for example, you could potentially lose your funds. And if the exchange doesn't cover your losses, then you're out of luck. And also some smaller niche projects aren't listed on centralized exchanges, and they do have withdrawal limits. So this can be a big doozy for all the whales out there that want their money in their own account, but the withdrawal limits of the exchange prevent them from doing so. Now let's talk about decentralized exchanges. Decentralized exchanges, DEXs, they are fully anonymous. They're great for investing into coins or into early projects that might not be listed yet on a centralized exchange. They are great for providing liquidity, yield farming, and staking options. They offer all those for passive income. And with decentralized exchanges, you need to understand that your crypto is 100% your responsibility. It is your keys. You are in charge. If you messed up, if you lose your keys, your secret 12-word phrase, 24-word phrase, you're toast. You lose your coins. So it's more responsibility than a centralized exchange where you just have your username and password to log in. And there's more technical knowledge required for DEXs. Market orders only, right? You can't pick the price that you want to buy or sell at. And there are charts on DEX tools we talked about, but there's no order book for analysis. So overall, what should you use? Once you really get into crypto, you're going to find yourself using both all the time, but start off on a centralized exchange. Learn how to use decentralized exchanges, because you're going to end up, if you really get into crypto, you're going to be using decentralized exchanges all the time. So they both have their own place. So to summarize lesson number 4, centralized exchanges and decentralized exchanges each serve their own purpose, like we talked about. Centralized exchanges are more widely used to trade in the markets. Decentralized exchanges enable users to swap their tokens and farm yield on their assets, right? Decentralized exchanges are decentralized applications built on smart contract blockchains. Centralized exchanges are operated by a company, and they operate as a business. Their goal is to make money. You're the customer. That's why you pay commission, trading fees, etc. That's why they have withdrawal limits, because if you withdraw your money, well, then they're going to have less liquidity to run their business, their exchange. Understand how this works. You need to understand everything going on. All right, let's move on to lesson number 5. This is a big one. This is leading up now towards lesson number 8, where we actually go ahead and we place some trades, and I'll show you how that actually works. All right, so lesson number 5, the basics of trading. So there's different strokes for different folks. What that means is that everybody has their own strategy. Everybody has their own way of looking at the markets. What works for me and what I like, you might not like. It might not work for you. So there's different strokes for different folks. Remember that when it comes to trading. It's highly subjective. Everybody is different. There's 1,000 ways to skin the cat, as they say. So what entails a trading strategy? We're going to be talking about that. We're also going to be discussing day trading, swing trading, and long-term trading investing. We're also going to be talking about dollar cost averaging, as well as the best strategy. So that's subjective to the individual, like I said. Some people are great day traders and they don't like swing trading. They don't have enough patience for swing trades. Some people hate trading and they just want to invest for the long term by dollar cost averaging. We're going to be talking about that in this lesson. So let's get right into it. First, what I'm going to talk about is day trading. So day trading is any trade that lasts for 24 hours or less, really 23 hours and 59 minutes or less, right? Anything over would be over 1 day's time, and that would be a swing trade technically. So a day trade usually consists of very short-term trading which is commonly referred to as scalping. You're going to hear the word scalping a lot. And basically with scalping, you're trying to capture a very small percentage move in a very short amount of time. You're usually going to use, like I said here, the 5-minute, the 15-minute, or the 1 hour. For scalping, you're going to be on the 5-minute chart or the 15-minute chart. So day trading is based purely off of technicals, off of technical analysis. There's no fundamentals when it comes to day trading, really. You're looking at the charts and you're trading your edge in the market. We're going to be talking about what an edge is later on in this course as well. And then as well, you're looking to capture a small percentage of a price move, like I said. And this can be used as a source of active income. I personally know day traders that make a very good living from scalping in the markets. So if this is up your alley, I know a lot of people that absolutely crush it as scalpers. It's definitely possible. And day trading requires skill and control of emotions because your stop losses will be hit. Sometimes when you're scalping, you can be taking 20, 40, 50 trades in a day, right? Your stop loss gets hit. You're looking for the next opportunity. You need to be emotionless. You need to kind of be like a robot to be a successful day trader. You're playing off of probabilities. And think of it as a casino, and as the casino, you want to operate as the house. You want to have a slight edge in your favor, and that is what trading with an edge gives you. It gives you that house probability. So understand that day trading is very time and capital intensive. To really crush it as a day trader, it helps to have a lot of capital, and it's a full-time job. You're going to be in front of your computer screen, glued to the screen, watching the charts, watching the quotes come in. So understand that day trading is very intensive. But for some people, they love it, and they make a very good wage from day trading on the daily. So here is a little example. We're on a 15-minute chart of Bitcoin. And here we can see, I do have this yellow horizontal line. And we can see how price had this one candle wick up to the line, right? And then it went into consolidation again. And then we had this huge bullish engulfing candle. And then we had this retest. So this would be your entry, right? You see this huge bullish engulfing candle. So that tells you that price is breaking out. And then we have the retest down below of this, the base of the breakout. So as a scalp, as a day trade, you would use this yellow line as your entry because you put it just above the resistance. You get triggered. And then you would actually take your profit very close by. You look to the left and you see there is some resistance, some supply over here. And you would use that as your profit target. And this would be a quick little scalp trade on the 15-minute chart. You get hit, your profit target would get hit within 3-4 hours. You'd be out. So that's one example of a day trade. Understand it's 1 day or less. Next, we have swing trading. Swing trading is my preference. I am a swing trader, and swing trading is the most popular style of trading in my opinion because it is less intensive as day trading, and it can still provide an amazing opportunity to capture large market swings, meaning very high profits for your portfolio. So a swing trade lasts for 2 days up to 4 to 6 weeks really, and it is short to medium term in terms of how long you hold the trade for. So for swing trading, you use both fundamental analysis and technical analysis to seize opportunity in the market. Personally speaking, my best trades have been when I combine the fundamentals and the technicals, when they line up. Those are the ones that go absolutely bananas and provide me with astronomical returns for my portfolio. So swing trading, definitely if you can't be constantly staring at your computer, but you still want to learn how to trade, it's probably for you. You're going to figure that out on your own though, of course. I can't tell you what is best for you. You need to discover that with your own applied application knowledge. All right, so swing trading, you're looking to capture a percentage of a price move. You're not married to the coin. Same thing with day trading. You're not saying, oh, I love XRP so much, I'm going to open up this swing trade on it because it's going to the moon. No, you don't care about the coin. You look at the chart and you say, okay, I'm going to take this as a trade. I'm going to sell when it hits this point. I'm not emotionally tied to this position. So you need to understand that it's not the same thing as investing where you really believe in a project and you think it's going to do really well. No, a trade is different from investing. Get that mindset shift in your head. Do not hold on to a trade because you were emotionally invested in the project. Emotions will get you absolutely destroyed in crypto and in all financial markets. So understand that. Swing trading is not as intensive as day trading. You can really set and forget your orders. Just look at them maybe once a day, manage the trade. It's not that hard to manage the trade once you know what you're doing in a swing trading position. Once you do have your entry filled and you're in it, you just kind of let the trend ride out. You ride the wave. So there's opportunities for short-term profits. Sometimes a swing trade can last 3 days and it can provide you with hundreds of percentage returns, right? That's one of our recent trades on HBAR actually in the Crypto Empire Premium Discord group. I did actually call out HBAR back on September 7th. That was the day we had the huge market crash when El Salvador made Bitcoin legal tender. I said HBAR is impressing me with how well it did hold up during the crash. It went right back to our original entry at 24 cents. And it started buying its way back higher. Buyers just stepped in. Said holding HBAR spot will most likely give you a 2x minimum easily as soon as the market starts to trend again. So that was on September 7th. Current date is September 15th. We can look at the market cap, see the top gainers for the day. And we do have HBAR now trading at 52 cents. It did hit 56 cents, new all-time high. So just 8 days later, we saw over a 100% return on a swing trade inside of the premium Discord group with HBAR. So swing trading can be quick profits, really. You can make an astronomical amount of money very quickly. So again, with swing trading, you're looking to capture a trend. You can miss potential longer term profits because, like I said, you're not emotionally invested in the trade. When your profit target gets hit, you're out. And if it keeps on going up, well, then you're going to potentially miss out on those longer term profits if you held it as an investment. Another thing with swing trading is short-term market swings can trigger your stop loss order, stopping you out of the position and resulting in a loss, or maybe you move your stop loss up after you were already in profit, managing the trade that way, and you would get out on a small profit or significant profit if you've been in the position for a while. But nonetheless, your stop loss can definitely get hit in swing trades. It's not all sunshines and rainbows. You face the risk of losing your capital 100%. And we usually focus on the 4-hour and the daily price charts when we are swing trading. All right, moving on, we do have this HBAR chart, right? So HBAR, our original entry was over here at 24 cents. We saw this was a pretty significant support resistance flip level, ascending triangle. We're going to be talking about that later on in the course. And then basically we had the El Salvador crash. Buyers stepped in fury. I realized, I was like, look, this thing just got bought up, tapped our entry and just rocketed. I was like, ape, not financial advice, and we're up over 2x a week later. So this was a beautiful swing trade, and we're going to keep on riding this one, guys. HBAR is not finished by any means. All right, now let's talk about breakout trading. So breakout trading, this is a short to midterm style of trading, so it can last from hours to days. And you use technical analysis for your entry, stops, and targets, and you use specific chart patterns. You need to learn the chart patterns. This is an ascending triangle, one of my favorite chart patterns in a bull market, especially in crypto. It's very easy to spot once you see it, and then once you learn how to trade it, you just rake in money all day long in the bull market when the market is trending. That's the key. We're going to be talking about the trend as well. The trend is super important. You need to understand how to identify the trend. When you combine the trend with chart patterns, it makes it pretty easy to trade. All right, so you're looking to capture a breakout in price action. This is an opportunity for quick short-term profits. You must have a trading plan in place. You need to be disciplined to be successful. What do I mean by that? You're waiting for the breakout. So you don't enter below the breakout because it can go against you and it could essentially, the trend could turn around and you can be in significant loss. So you need to have the discipline to wait for your breakout entry to be triggered. You need to have the discipline to set your stop loss, take your profits at your predetermined profit targets. All of this requires discipline and to have no emotions in the trade. So for breakouts, we usually use a 1 hour or 4 hour or daily. Really, the higher the time frame, the more reliable the breakout pattern is. False breakouts do happen. You may get stopped out. We see false breakouts all the time. Price breaks from a level, sellers push it back down, you get stopped out. And then also in breakouts, you may miss the longer term trends, again, because you're not really investing. You're taking your profit target when it gets hit, and the price could keep on going up after it gets hit when you were long, and you can miss out on those longer term gains. So here's an example of a breakout. This is actually on the Bitcoin dominance. We were going sideways in consolidation, and this was a downtrend. We made lower lows. We'll talk about trend in a second. We made a lower low, then we were going sideways. And I actually called this when I first started the YouTube channel, actually, back in March. I called really the first altcoin season beautifully here at Crypto Empire. We made a ton of gains, the Crypto Empire community. So again, if you're not subscribed, hit that subscribe button down below and turn on all the notifications so you don't miss any future videos, so you are alerted when everything starts getting really hot again. And really everything's picking up at the moment, so you're in the right place at the right time. But nonetheless, you can see how the bottom fell out from the support level, and you would have entered basically at the low of these candle wicks, and you would have rode the trend downwards. Now obviously Bitcoin dominance, you can't trade that, but this is a perfect example of a breakout of price action. All right, dollar cost average investing, so otherwise referred to as a DCA. This is a long-term strategy based off of fundamentals of a project. This is not trading, this is 100% investing. You have a low time preference, meaning you don't care if it takes 10 years for the investment to come to fruition. You have the patience. You're going to keep on doing your dollar cost average, buying week after week or month after month, however you set yours up. Not short term by any means. You don't care about the current price. You buy regardless, right? Because your strategy, let's say your dollar cost average, we'll give this example. We'll talk about the example in the next slide. But nonetheless, you don't care about the price when you dollar cost average. You just buy sticking to your strategy. This is the easiest, most stress-free approach to cryptocurrency. And really, it's a foolproof approach to making money in crypto. If you had just dollar cost average into Bitcoin or Ethereum over the past 2, 3, 4 years, you'd be a millionaire now, putting like $50, $100 in a week or a month. Because it just adds up over time, and with an asset like Bitcoin where it just keeps on going up against the dollar, which you use to invest in, right? We talked about that earlier. Bitcoin is the base, the dollar is the quote. You sell your dollars to buy Bitcoin. It just keeps on going up over time. You have your automatic recurring buy order set as a dollar cost average. Basically, it means you put, let's say your dollar cost average is you want to put $100 into Bitcoin every single week on Friday at 5 p.m. And you set that up in your account, whether that's your Cash App or your Coinbase account. Every single week, Friday at 5 p.m., the application automatically deducts that $100 balance from your bank account and buys Bitcoin with it. You leave that and you let it do its thing, and it's really a foolproof approach to becoming a millionaire if you have the capital and the patience over years to make a lot of money in crypto. You can do it with altcoins that you believe in, and it's a very good way to go about things, is what I'm trying to say. So if you're bullish on a particular asset longer term, this is the approach to take. If you are wrong, you can suffer significant losses because, again, you're buying it over and over and over again. So for DCAing, we use the daily, weekly, and monthly charts for our analysis, but like I said, you don't care about price. It's based off of fundamentals. So here is a dollar cost average example. Basically over here, you're DCAing. So over time, you are buying every single week or every single month, however you set yours up. So your total amount is going up over time, right? With a lump sum approach to investing, you buy everything you have at one time, and you don't get any more of it over time. So your average price will be whatever you bought it for. With a dollar cost average, 1 week you might get it for really cheap. Then the next week, let's say Bitcoin pumps up 10 grand, so you buy Bitcoin more expensive. Then it drops 12 grand, so you get it cheap again. Then it pumps 20 grand. These are obviously theoretical examples. But you get the average price over time as a dollar cost average investor. So that's why you don't care about the price. You're just getting the average of the price over a given time period. So it's a great approach to take, especially if you're newer, especially if you don't really want to learn how to trade, or you don't have the time to learn how to trade. You just want to be in crypto. You want to be invested. Then dollar cost averaging is the way to go. But if you are a crypto lifer like myself and like a lot of the Crypto Empire community is, well, then you want to learn how to trade, of course, and you want to learn how to make bank from trading. All right, let's summarize lesson number 5. So day trading requires technical analysis and risk management skills. It's very skill intensive. Day trading is a full-time occupation that requires your full attention and time. Swing trading is widely popular as it is less intensive than day trading, but you still need to know what you're doing and manage your risk and have technical analysis skills. And all strategies can be used in conjunction with one another. So you're not tied down to only day trading or only swing trading. You're dynamic. You can move in between. You can do what you want. So don't feel like you're restricted to one kind of trading. All right, lesson number 6 now. This is a big one. This is very important, especially if you're newer and you don't know this information yet. This is critical. Let's talk about the different types of orders. We will be explaining limit orders, market orders, and then stop orders as well. So we have the stop market and stop limit orders. You need to know what those are. We're going to talk about the bid-ask spread. We're also going to talk about the order book. And then we're also going to talk about how each order type has a very specific use case, and you need to know what those are. All right, first things first, let's talk about the order book. So it's good to know what the order book is, but you don't really need to know how to use it. So an order book is basically, it shows you all of the orders of where buyers are and where sellers are as well. We can look at Binance, and this is the live order book. Basically, we have sellers up here in red, and we have all the buyers here in green. We can see the amount of Bitcoin that they either want to buy or sell, at what value that does equal in Tether. So basically, it allows you to see all of the orders on the exchange, but not all of them, right? Not all the orders are made public. If they did that, well, then everybody would know each other's hands, and you can't show your hands, especially when you're trading. You can't show your cards. So not all the orders are made public. If that was the case, then you can front run people, you can do your own kinds of market manipulation. So understand that not all the orders are here. So the sellers are on the top, the buyers are on the bottom. And basically, I'll explain the bid-ask spread. So the bid is what the buyers want to buy Bitcoin for. We can see the closest bidding offer is for 47,900. It's changing constantly, 47,913. And then the ask, what people are asking for the price of their Bitcoin, is 47,916 right now. So we can see this is 47,916.30. This is 1631. So this is the lowest spread you can see. That's 1 cent. That's what you want. But basically, this is the ask, and down here with the buyers, that's the bid. And the bid and the ask are the numbers closest to the market price, which is in the middle here. So bid-ask spread explained. I did just explain it, but let's read the text. The bid-ask spread is the difference between the highest bid and the lowest offer. As a trader, you want a very tight spread because you don't want to suffer from slippage. This is why high liquidity is crucial, because you can suffer from slippage. So for some low liquidity coins, we might have people looking to buy it at $40 and people are looking to sell at $50. So that $10 spread in between is called the bid-ask spread, because that is the price difference between what people are willing to buy for their Bitcoin or altcoin and what people are willing to sell for that particular coin. That's the prices they're asking for, and in between is the spread. All right, that's the bid-ask spread. Now let's talk about what a market order is. So a market order, you buy or sell at the current market price. So you can choose how much you want to buy or sell, but you cannot choose the price. It is automatically executed at the market price. When you use a market order, it is referred to as a taker order. You are taking liquidity from the exchange. You're not adding any liquidity, you're taking liquidity away. So a market order is very easy to use, and it is instant. So if you're in a rush, you just want whatever you want to buy, you use a market order, or whatever you want to sell. You can suffer from very high slippage, which can accrue a very large loss. So if you're selling high amounts, it's probably best to use a limit order. And you can pay a premium for your cryptocurrency if you do use a market order. So let's hop on over to Binance. Basically over here on the right, you see limit and market. If you wanted to use a market order, you would hit market, and the price automatically set at the current market price. And then let's say you wanted to buy $10,000 worth of Bitcoin, you would hit buy BTC after you put in 10,000 USDT, and it would automatically get filled at the current market price, which we can see is $47,914. And that is a market order. It's instant. You pay the current market price, you do pay a little bit of a premium. It's higher fees because you're not adding liquidity, you're taking liquidity. But if you need something in a hurry, you use a market order. Then we have the limit order. So the limit order allows you to have control over the price you buy or sell the asset at. You can choose the amount you want to buy or sell. This is referred to as a maker order. You're making liquidity for the exchange. You're adding to it. You're saying, I want to buy Bitcoin at $10,000 lower than the current price. I will put in my USDT in the order. The exchange then has your USDT as liquidity, which they can use to make everything smoother for the other traders, etc. They're running their business. And with a limit order, you're not guaranteed to get filled. If price never comes to your entry, then you don't get filled. It can sit there until you cancel it. We call that an OCO, order cancels order, or a GTC, good till canceled order type. So if we wanted to use a limit order, we would come over here to limit. We would put the price we wanted to buy Bitcoin at. Let's say we wanted to buy Bitcoin, it's 47 grand right now. We wanted to buy it at 44. So price 44, amount we want to buy one Bitcoin. It's going to cost us $44,000. And then we would hit buy BTC. We would have our order placed at 44 grand. It would show up down here in open orders. We would see buy one Bitcoin at $44,000. And until price reaches $44,000, our order sits there. If it never hits 44 grand again, well then our order is still there until we cancel it because it's a GTC, good till cancel order. And that is a limit order. Next up, let's talk about the stop market order. So a stop market order is you choose the price to place the order, but you are not guaranteed to get filled at that price. Okay, so it's kind of like a limit order where you get to select the price, and if price never reaches it, well then you never get filled. So you choose the amount you want to buy or sell, but once the trigger gets hit, it sells for the market price. So you don't necessarily, you choose the trigger price, but you don't choose the price because it's the market price that your order will get filled at. So some strategies utilize this order type. This is great for breakout trading. If price gets to a certain level, you're telling the exchange to sell your position with a market order. So how you would actually use a stop market order is you would go to the exchange. Let's use KuCoin now so you can see both of them, really the same exact thing. This is the order book. This is the chart. This is the current market price. You can see the bid-ask spread right now is 1 cent approximately. So yeah, that's KuCoin interface. So for a stop market order, you would come over here, you would hit stop market. So over here it says stop price. This is your trigger price of when you want the order to get filled. So if you wanted to go long on Bitcoin on a breakout trade, let's say you wanted to go long BTC above this high over here at 52. This is a daily. Let's go to a 1 hour. So let's say you wanted to go long Bitcoin when it breaks out above $48,500. What you would do here for your stop price when you have the stop market order selected is you would put 48,500. Now this is your trigger price. Then you would put in the amount of Bitcoin that you did want to buy. So let's say you wanted to buy $5,000 worth. So you're saying when price hits 48,500 on a breakout, your stop market order will get triggered, and then whatever the current market price is, you'll get filled. That's how it works. It's not a limit order, but it's a market order with a trigger price. Very useful for trading. Now we also have the stop limit order, very similar to the stop market order. So the stop limit order, you choose the price you trade at and the amount you want to buy and sell. So you choose the price to place the stop limit order. It's great for scaling into a position at a specific price level. So if you're going to be trading leverage, you're going to need to learn how to scale in and out of your positions. You never want to go all in with all of your capital at your first entry. You want to learn how to scale in and out. It's really good for making it kind of hard to lose once you learn how to do this stuff. Subscribe to the channel. I will be making videos on how to scale in and out of leverage positions because you need to know this. You absolutely need to know this. So with a stop limit order, you were saying, if price gets to a certain level, sell my position with a limit order. You're guaranteed to get that price. Or I'll say as well, sometimes price will leave so quickly that you can't actually get that price anymore and your order will just sit there. But so for a stop limit order, basically the stop price, again, this is your trigger. So you're saying when Bitcoin, you want to go long, let's say when Bitcoin gets above $48,400, that you would buy 5,000 Bitcoin at the price of $48,000 you can put as your price you want to buy at. So let me explain this. You're saying as your trigger price, when price breaks out and touches $48,400, your order will be activated. It won't be executed. It will be activated. And then if price drops back down to $48,000, then your order gets filled. It gets executed. So this gives you some flexibility. It allows you to play around with trigger prices in different scenarios. Let's say you wanted to trade the pullback of a breakout. So you put your trigger price at the breakout level, and then your entry price, your limit order price, slightly below. So price taps the breakout and then pulls back on a retest. You get filled there, and then price moves in your direction. Hypothetical example, but it does happen. I do use it like that. So good to know how to use both stop limit and stop market orders. And then we also have the classic stop loss order. So a stop loss stops you from losing all of your capital if a trade does go against you. Stop losses are crucial for day trading to manage your risk. You do choose the price level that you set the order based off of technical analysis. You need to know how to read the charts and where to put your stops. Must be placed below the current price, right? If you're going long and we're short, you want to place your stop above the current price. And this can be a limit or a market order. So we can see from this example, this trader here, he went long right here, right? Price moving in his direction, but then reversed. He put his stop loss right here. Stop loss gets hit. Then he uses the stop limit order to go short. So that's a little bit of an example. Also, there's the take profit order. So you can set these at the same time when you place your entry. You can set the entry, profit, and target all at the same time. The exchanges do let you do that. So a take profit order, this is a stop limit or a stop market order that you will sell a long position or buy a short position. When you buy a short position, you're not adding to it. You're simply equalizing the amount that you sold. So a take profit order, it makes you money. When it gets hit, you make money. This is crucial for day trading to get in and out of positions. You do choose the price level to set the take profit order based off of technical analysis. Again, you want to know when to get out of the trade based off of what the chart is telling you. And it must be above the current price when you're long and below the current price when you are short in a position. So we can see this trader over here, he put his stop loss and he avoided some losses, and he also made money when the take profit order got hit, so he's happy, right? Look at that smile. All right, lesson number 6, summary. There's 1,000 ways to skin the cat. A lot of different strategies out there, a lot of different ways to do the same end goal, to get to the same end goal. So trading is very subjective. If one person does it different, they're not wrong and you're not right. They just have a different approach to the market. Understand that. Market orders and limit orders allow flexibility when trading. Stop loss orders are great for managing your risk. Stop market and stop limit orders can be used for taking breakout trades, taking profits, or as a stop loss. Each order type serves a specific use case. You're going to find yourself using all the orders, so learn all of them, learn what they are. Get comfortable placing the different order types. Get comfortable on the exchanges. I can't tell you how much I see some students struggle with just placing orders, and that's like one thing holding them up from making profits in the markets. Learn how to place your orders. Learn the different order types. All right, we're on the second to last. I know you guys are disappointed. You want this to go on forever. We're on the second to last lesson now. Lesson number 7, technical analysis in crypto. So in this lesson, we will identify the trend as well as trend reversals. We're going to identify types of chart patterns. We're going to talk about supply and demand, support and resistance, candlestick charts. We're also going to be discussing some indicators that I use. And then we're going to talk about how to enter/exit trades with TA, technical analysis. So, technical analysis, just data, no emotions. You're literally reading the data and making decisions based off what the chart is telling you, not what your emotions are telling you. So the use of chart patterns, trading volume, price data, and analysis tools to trade. Technical analysis gives traders an edge or a systematic strategy in the market that can be fine-tuned over time. When you're taking the same technical entry over time, you're going to learn what works and what doesn't. You can fine-tune your strategy to have a higher success rate. So technical analysis isn't 100% reliable. You're going to need some experience to really learn how to do this. So don't just think you're going to be a pro wizard after watching this course one day of trading. Everybody has their own journey, but you're going to need to learn by experience. That's me subjectively speaking. All right, now Japanese candlesticks. So Japanese candlesticks were actually invented centuries ago when Japanese traders were trading rice and they wanted a way to track the price to figure out when was a good time to buy rice and when was a good time to sell grains of rice. So candlestick charts, they give details about price to anticipate what may happen in the future. Candlestick charts show the highest traded price and the lowest traded price in a given time period. Right, we can see over here with the green bullish candle, the high and the low. So was the open and the close. And professional traders use candlestick charts because of the amount of data that they do provide. More so than a line chart or something else, monkey bar chart. Candlestick charts give you the most data. So how exactly do you read a candlestick chart? If it's green, that means that the open was lower than the close. Like it closed at a higher price than it opened. And the wick high and the wick low, these are the extremes of the trading range. Let's say this is a daily candle. Price opened down here, closed up here, but it went as high as this wick and it went as low as this wick's price. But the bulk of the trading took place from the close to the open. So this just tells you the extremes of the wick. Most of the volume of traded assets takes place in the body. Same thing with a bearish, a red candle. You have the high, you have the low. The open and the close is lower than the open. Price is lower from where it opened, say in a day. So that would constitute a bearish candle. And the body, again, is where the majority of the traded volume took place. The wicks represent the extremes of the trading range. Moving on, we have some specific types of candlesticks. This is the pin bar. So the pin bar can be bullish or bearish depending on price, of course. If it's red, it's going to be bearish. If it's green, it will be bullish. As an indication of what the next candlestick will be, it can be used. So, for example, a bearish pin bar indicates that sellers are strongly pushing price down. So this is a good indication that the next candle will be a bearish engulfing candle. And with that being said, the wick is a good indication of how big the next candle will be. For a super long pin bar, that's a good indication that the next bearish candle will be a very big red bearish candle. So it's a good shorting opportunity. For a bullish pin bar, you can also call this a hammer candle. For a bullish pin bar, basically it's showing that buyers are stepping in very strong, pushing price back higher. And you can use the wick as a gauge to know how big the next bullish engulfing candle will be. And pin bars represent a longing or shorting opportunity if they're bullish or bearish, but definitely learn to read pin bars, identify them when they do pop up. They're very helpful. So for a pin bar, let's actually give an example right now. Let's look at Bitcoin. So on BTC, we can see that we do have a few pin bars down here at the bottom of this range that we had this previous summer. And we have a few. We have one right here. We have another one right here. And another one right here. Basically, I mean, these are pin bars as well, but let's look at the more obvious ones. So what happened here? Sellers were pushing the price down, but buyers actually stepped in and pushed the price back up higher. And now, although this candle did close red, meaning that the opening price is higher than the closing price, although it did close red, it is bullish because buyers are the ones pushing this back up. Now it closed slightly in the red, and then the next candle, the next day, this is a daily chart, buyers stepped in heavily with this bullish engulfing candle. That's our next candlestick pattern, a bullish and bearish engulfing candle. We'll get into that in a second. But basically, this pin bar was an indication that the bulls were strong and price is going to move higher, and that's exactly what it did. Then again, huge sell-off, huge candle wick down, but the buyers stepped in again. That's an indication that there's strength in the market. So it's an indication to go long, right? And then we went right into a supply zone right here. We'll talk about that in a second as well. Price came back down. We had another pin bar right here. And then the next one, we had a nice bullish candle, and then that would have been a longing opportunity. So that is a pin bar. That's how you identify it. It just proves that buyers are stepping into the market, and it is a sign of strength. And then we also have the bullish and bearish engulfing candles. So when the current candle fully engulfs the previous candle, this is referred to as an engulfing candle. This is an indication of a strong reversal in price action. And this can be very bullish or very bearish, depending on the direction of the move, of course. So let's go back to our chart. And again, right here, we have this pin bar showing us that buyers step in. And then the next candle, we can see, so this red candle, it traded as high as this level and as low as this level. And we can see that this green bullish engulfing candle actually fully engulfed this entire candle. So the entire green body is bigger than this entire red candle. That is super bullish. Very, very bullish in price. That is an indication that price will continue to move higher. Super bullish. Then we also have bearish engulfing candles. This is a perfect example right here. So here we have a drop base, or a rally base drop supply zone. And this is a strong supply zone because how quickly and strongly price moved down from it. That's an odds enhancing indicator when how price moves very quickly and strong out of the zone. But nonetheless, this red candle fully engulfs this green candle. So that's a bearish engulfing candle and bullish engulfing candle examples. Learn to spot those. It will help you out in your trading 100%. Now moving on, let's talk about identifying the trend. Super important, because the trend is your friend until the end. If you trade against the trend, you're going to have a bad time. You're going to wonder why your chart patterns aren't working, what's wrong, what are you doing wrong. If you're going against the trend, you are swimming against the current, and that makes it very hard. So if you can identify the trend, you can ride the wave for a profit. Just like if you're going with the current, it makes swimming very easy. The trend can and should be used in conjunction with chart patterns. The trend is the most crucial part of technical analysis. If you get the trend wrong, then really everything else is out the window. If you're trading against the trend, you're going to have a bad time. At least my style, at least. As a swing trader, I like to trade with the trend. So an uptrend constitutes higher highs and higher lows. A downtrend constitutes lower highs and lower lows. And a trend can either be up, down, or sideways. So this diagram gives you an example: higher high, higher low, higher high, higher low, etc. Let's look at the actual chart and identify an uptrend. So on Bitcoin, it's very easy. Basically, what we have here is we have this trend reversal. This is we're going to talk about the W as well. But nonetheless, we have the start of the uptrend right here, this low. Then we pump up from 28,000 up to 42,500 before we see any kind of pullback, right? And we clear this high. So this is a higher high here. We pull back and we don't make a lower low. What would make a lower low is if we went back below 28,000 and closed beneath it. We don't have a lower low here. This is a higher low. Then again, we pump up to about 47, 48,000. Small pullback. Another higher high, higher low. Again, we pump up. We retrace, but we don't make a lower low. So this is a clear uptrend, and this is how we identify the uptrend. Now, obviously, with the flash crash, we made a lower low, and then we went into a period of consolidation or a sideways trend here. Right, price is just going sideways, no real direction. But that is an uptrend and how you identify it. You just look for higher highs and higher lows. And really the same thing with the downtrend. If we look at the Wyckoff distribution top on Bitcoin, we have the all-time high over here, 65K. We go down. As you can see, we break this low here. Right, we break that low, make a lower low. We pump back up. We make a lower high. We don't get back up above this. That's bearish. And then we fall through the floor. We make another lower low past this previous low. So that is a downtrend, and how you identify the downtrend. Always, that's the first step, identifying the trend. You need to learn how to do that. So there can also be a sideways consolidation. So with sideways consolidation trends, there's no clear direction. Price action is very choppy, and consolidation usually comes before a breakout. So it gives you time to prepare for that next move. I personally love consolidation trend patterns because it lets you know that a move is coming. Prepare yourselves, get ready for it. Position yourself to play from a position of strength and ride that breakout. So buyers and sellers are at equilibrium in a sideways trend, and they serve as excellent opportunities to position yourself for the next move, like I just said. So sideways, we're breaking out of a sideways trend right now on Bitcoin. It's looking bullish, right? We cleared this high, so we made a higher high, but nonetheless, for 1, 2, 3, 4, 5, 6, 7 days, for 1 week, we were going sideways, and now we're breaking out to the upside. And we're bullish on Bitcoin here at Crypto Empire, so we were expecting this breakout to the upside. Bears don't know how to read volume, right? Bulls are clearly in control. And yeah, we were expecting this breakout to the upside, and it's happening now. So this is a sideways trend. Another obvious example of a sideways trend is the one on Bitcoin dominance that I already showed you. You can see how price was just going up and down, playing ping pong, right? And then the floor just fell beneath it. That's the breakout that you look for after the consolidation. And this is sideways, just not going anywhere, super choppy. So learn to identify that. Moving on, let's start talking about some chart patterns. So to be a successful trader, you're going to have to get good at pattern recognition. Train your brain to spot these patterns. How you do that? Repetition. Repetition is the mother of skill. Go through the charts and identify the patterns. Take screenshots. Ingrain the image in your mind. So bullish and bearish patterns play out in the markets. Patterns are used for day and swing trading. The higher the time frame, the more reliable the chart pattern is. So if we're looking on a 5-minute chart and we see an ascending triangle, it's not as likely to play out as an ascending triangle on the daily time frame. So patterns are used together with candlesticks to make trading decisions, and they provide technical price targets as well. So you can determine what the breakout will lead to, where to take your profit target essentially. So the first pattern that I like to trade is the double top or the double bottom, also referred to for the double top, that's the M pattern. The double bottom is the W reversal pattern. I'm sure if you guys watch the channel, you all know about the W reversal pattern. Absolutely love that chart pattern. So it can be bullish or bearish depending on the direction. This is a trend reversal pattern. All right, so we look for that trend reversal with these W's and these M's. And basically this pattern represents price running out of momentum, and then the whole entire trend changes. So for this M bearish pattern, price pumps up, pulls back to the support, pumps up again, but there's no more momentum. So price gets rejected at the first peak, right? The second peak is always slightly lower than the first peak, and then it breaks down from the neckline, and that is the running out of gas, running out of fuel, and trend changing directions. Next up is the ascending triangle or the descending triangle chart pattern. Now we're in a bull market, so I'll stick with the bullish ascending triangle. So the ascending triangle means we have ascending price action with diagonal support. So we make a higher high, then we make a higher low using the trend line diagonal support. Higher high, higher low, higher high, higher low, higher high, higher low, etc. And then there is obvious horizontal resistance. That's what makes the triangle. It's like a wedge pattern. So eventually price keeps on tapping the obvious horizontal resistance, keeps pulling back to the diagonal support, usually a trend line, that's what we use, and then eventually it breaks out. So price becomes more and more constricted until it breaks out, and we can see the ascending triangle with consistently higher highs, or if it's a descending triangle, consistently lower highs leading down. So let's look at an example of a descending triangle. We can look at a position that I actually have open right now on SKL, starting to move in our direction. So with SKL, we can see that this yellow dotted line is the obvious horizontal resistance. We can see it was used for support over here 3 times. Then it was used as resistance or support again here, resistance here, resistance again here. It's a critical level on the chart at 44 cents. So now we can see price is clearly ascending. We have ascending price action, consistently making higher highs and higher lows. And now we've been trying to break through this horizontal resistance. We tried false breakout, rejected, back to support, right? And now we're finally, it looks like we're getting our bullish engulfing candle to break out here on SKL. And this is an ascending triangle in real time. This is how it looks like, right? Clear ascending price action, clear horizontal support. We trade the breakout to the upside, and we make bank doing that. All right, so that's not financial advice, by the way. Supply and demand trading. So supply and demand, very useful to know how to read the charts and identify supply zones and demand zones. So demand zones represent a point on the chart where buyers are likely to step in and push price higher. Supply zones represent a point on the chart where sellers are likely to step in and push price lower. They serve as very significant areas on the chart, and they can be used on all time frames. So for this supply zone, this is a rally base drop. For this demand zone, this is a drop base rally. And you can see price comes back into the zone after it drops, and then a lot of sellers step in and push price back down. For the demand zone, price very bullish out of the zone. There's leftover orders. Buyers are ready to step in when price gets back down here. Price gets back down and starts to move back up. So let's look at an example of some supply and demand zones in real time. So looking at the Terra Luna chart on the daily, for supply and demand zones, we look for, watch my full 2 videos on supply and demand zones if you don't know what they are yet. Basically, we have 4 chart patterns, 2 reversals, 2 continuation patterns. This is a drop base rally. This is a reversal bullish demand zone. So what happened here? We formed this drop base rally. Price pushed out of it. And then we had this super crazy candle wick to the upside, but sellers pushed it down. Price came back into the level of demand. Now this right here, this is called the stop loss sweep. Market makers stopped everybody out who was going long in this demand zone, but the zone still held. We didn't close beneath the distal line of the zone, and price exploded out of the demand zone. Came back during the flash crash. I mean, it went down to $22. Couldn't do anything about that. And then exploded higher again. So demand and supply zones work very well. I use them all the time in combination with the Fibonacci price retracement tool. And I have a very high success rate trading in that manner. So supply and demand, go and watch my full 2 videos about it if you want to learn more. It's a very intensive subject, but it's great to have in your trading repertoire. Next up, let's talk about support and resistance trading. So support and resistance, significant price levels on a chart. Support levels are where buyers are expected to step in. Resistance is where sellers are expected to step in. Supply and demand and support resistance are not the same, but they are very similar. The more you get into trading and the more you learn to identify, the more you'll understand what I mean by that. So when a support or resistance level is broken, this is referred to as a breakout. Support and resistance is more dynamic than supply and demand. We can go back in time further and see how these levels play out over time. Let me show you what I mean by that. We can go to an XRP chart. So you can see with XRP, I got these yellow lines all over the place because they are levels of support and resistance. And one thing you need to know is after a resistance level is broken to the upside, it usually then turns into a support level. So before it was a ceiling for the price, after price breaks to the upside, it turns into a floor for the price. So with these levels, we can see how price just stops at them right here at this $1.20 level. Price can't seem to close beneath this $1.20 level when it gets above. And then when it's below, it has a really hard time breaking above it, as we can see right here, as well as over here as well. We had this one bullish engulfing candle, but then we got rejected at the upper resistance, came back down. Then we used the $1.20 as support, broke beneath it again, broke above it, got rejected again at the $1.35 resistance. So we can see how support and resistance does play out over time. This is a skill that you'll pick up pretty quickly once you really get into trading, how to identify support and resistance. But basically, you are looking for key price levels on the chart where price usually stops, faces a hard time getting across that line. That is support and resistance. All right, now the 3 steps to taking a trade. Step number 1, always identify the trend. Trading against the trend can and will wreck you. The trend is your friend until the very end. Remember that saying, never let it escape your mind when you're trading. Step number 2, you need to identify price action. So, supply and demand, support and resistance, chart patterns. What is going on in the charts? This is where your technical analysis really comes into play. Third step, you identify your entry, stop, and target. So identify where you will take your entry based off of the candlesticks, based off of what price action is telling you. For the SKL example, we can see that previously this 44-cent level was used many times. Okay, so all these candlesticks are giving us data that this is a key level on the chart. Then we look at current price, and we're stopping at 43 cents, just below 44 cents. So we took the breakout entry at 44 cents above these wicks. So we used all the data to figure out our entry. So use key price levels on the chart to place your entry and your stop loss. For this example, basically, I chose the bottom of this doji candle here to put my stop loss. And for my profit targets, I chose, you can see this level right here, very obvious support, will be used as resistance most likely at 51 cents. Again, you see this candle wick down. I chose this as my next profit target at 59.8 cents. Then this wick high, I chose this as a target. So basically, you're just looking for prices on the chart where it's been used as support and resistance in the past, and we use that as our profit targets. More about that in future videos, and I talk about that a lot in the Discord as well. So yeah, all the resources are there for you if you're interested. So these are the 3 steps to a trade. First, you always identify the trend. Then you look at the price action, what's going on, is it bullish, chart patterns, supply, demand zone, support, and resistance, and then you figure out your entry, your stop, and your target. Now let's talk about trading indicators. So trading indicators are very useful. I do use them, but I do not rely on them, and I rely mainly on price action, on candlesticks, and on chart patterns, supply and demand zone, support, and resistance. Indicators are helpful, but don't rely on them. Depending on your strategy. Myself, I love price action. I'm a price action trader. I don't really need indicators. With that being said, indicators are a collection of data that give context to price action. It literally takes into account all of the prices over a given period of time, and it spits data back at you. So indicators are used to identify the trend reversals, strength of the market, if an asset is overbought or oversold, etc. Many different kinds of indicators. They are not 100% reliable. The market is dynamic, it is always changing, and you can't just rely on an indicator to tell you what something is going to do. It's not that simple. So indicators makes data more concise and understandable for some. Some people love them, some people hate them. Depends on the trader. It's very subjective. So the first indicator that I do like, that I do use from time to time, is the moving average. So the moving average is the average price over a given period of time. If we're looking at a daily chart, we can set the moving average to be the past 200 days or the past 50 days, the past 20 days. You can set the time frame that you want the moving average to be. And there are 2 kinds of moving averages. There's the regular or simple moving average, and this is basically just the arithmetic mean of prices over a given time period. And then the EMA, the exponential moving average, it's weighted data, and it gives more weight, more importance to the most recent prices in the market. So we can look at the chart. If we go back to Bitcoin, looking at the Bitcoin chart, you can see over here, I do have a moving average. This green or this orange line right here, this is the 200 simple moving average. Then I can pull up the exponential moving average, that's the red line. You can see that there are different points in the chart because the exponential moving average gives more weight to the current prices. Okay, so both of them can be used to identify the trend. When we're above the 200 EMA, that's a good indication. And when we're above the 200 moving average as well, that's a great indication that we're in a bullish uptrend. So we're above both of these, so that tells us, things are looking very bullish. After that, the other indicator that I use very often is the Fibonacci price retracement. So the Fibonacci is based off of the Fibonacci ratios. The 61.8 is the golden ratio. This is a very important level in the chart. So with the fib, basically you attach it to the high and the low of a given move that you do want to measure. Fib levels are typically critical reversal levels on the chart. And if price does break one fib level, it is likely to move to the next fib level. And the Fibonacci is an amazing tool for trading pullbacks during a trend. If we're in an uptrend, you want to buy the dip. The fib is an amazing tool to do that. Within the 50% and the 61.8 retracement levels serve as very good entries on pullbacks in an uptrend. And the fib is also great for finding spots for stop losses, right? You can place them beneath critical fib levels. You can say, all right, if price breaks this fib level, I want to get stopped out, I want to be out of the trade. And with the fib, the 61.8 and the 38.2 are the levels that are used more often than the other ones, I would say. So we can look at the chart. What I'm going to do is I'm going to measure the move back up. So we had this huge drop down, right? And then we started to move back up higher, right? So if I measure the move back up, we can see where we actually stopped. And if I do that, what I do is I hook it from the bottom up to the top, the all-time high. And we can see that the 61.8 and the 0.65, this constitutes the golden pocket. We can see price came right into the golden pocket and then got slam rejected down with that flash crash that we saw on September 7th. So the fib, here in this example, the golden pocket, the 61.8, was used as resistance. Now, what if I want to measure this move? We had this move up high, and now we had this pullback with the flash crash. Where do we actually drop down to? Well, we can take the fib, and we can hook it from the high of the move to the low, the local low where it originated from, and we can see that the 38.2 was used right here as support. Very common to see the 38.2 used as support in an uptrend. So the fib is an amazing tool. I absolutely love it. I use it for pretty much all of my trades, except if I'm taking a breakout. But nonetheless, big fan of the Fibonacci price retracement tool. It's very popular for very good reason. It just works. All right, now let's summarize lesson number 7. You can see myself right here with some Crypto Empire Knights holding the line. That's how we do it over here. Technical analysis is a critical skill for trading. Technical analysis is used to identify trends, chart patterns, and opportunities in the markets. Supply and demand zones show where buyers and sellers are likely to step in. Candlestick charts are used for technical analysis. Technical analysis gives us an edge, something to do over and over and over again that puts the probability in our favor. We're like the house at the casino. We have the edge. And indicators are very helpful for identifying trends as well as taking on trading opportunities. All right, we made it to lesson number 8. It's time to give you some trading examples so that you can take your trading skills to the moon. Let's get into it. But before we do, let's take a little bit of a refresher. There's 3 steps to the trade here at Crypto Empire, how we do things. First, we identify the trend. Second, we identify the price action. Supply and demand, support and resistance, chart patterns, what's going on after we know if it's an uptrend or a downtrend. Next, we set our entries, we set our stops, and we set our targets to go ahead and take the trade. Okay, so let's also go over swing trading. Right, I'm a swing trader. Trades last for 2 days, up to 4 to 6 weeks for a swing trade. We already talked about this, right? Short to medium term, we use fundamental and technical analysis. We're looking to capture a percentage of the move, and we're focusing on the 4-hour and the daily. We're focusing on riding the trend. And also, let's recover the breakout trades. So ascending triangle, my favorite. Breakouts are amazing once you learn to spot them. False breakouts do happen, so you may get stopped out, but pattern recognition is the name of the game for identifying these breakouts before they happen so that you can ride them up higher. And of course, you use your technical analysis skills for your entries, your stops, and your targets. So now it is time to give some real concrete examples of trades. So let's go ahead and let's look at the chart. So with this in mind, I want to let you guys know how I personally do things. If you use Binance or KuCoin, you can use their charts. They do have TradingView. You can customize it, but I have a TradingView account. I pay. It's free if you want to make a TradingView account. I do pay monthly because it allows me a lot of flexibility with my analysis. And then I simply just hop on over to the exchange, and I use the exchange to place my orders, but I do all my own charting on TradingView. That's just how I do things. Some people like to only use the exchange. Whatever, that's subjective. Figure it out for yourself how you do want to do things. I'm a big fan of TradingView. It's an amazing charting analysis platform. So we're now looking at the Ethereum price chart. And with ETH, if you guys see this over here, we were in a sideways downtrend over here. We made a low, and then we made an equal low. So this would constitute as a double bottom, right? We didn't make a lower low. We made an equal low here, which is very rare actually, but nonetheless, this is a W. So what you would do is you would put your neckline on the chart. The neckline is where price does stop, and that would be up here. I'm going to put it along the candle bodies, okay? So for a W, how you actually measure the breakout is you take it from the high of the neck down to the low of the move. And this line is your measurement for your price target. Very simple to do that. So you would literally use this as your target for the trade, right? You would put a line there at $3,039, and that would be your target. Entry would be the break of the neckline. And then for your stop, basically you want to put your stop underneath an area of support. So we can look to the left and we can see some support areas on the chart, right? We do have this area really from right here. We can see how these candle wicks were used many times. Once here, another more times here, more here, more here. So this tells us that this is an area of support on the chart. So if we're going to take our entry at this yellow dotted line at $2,329, what we would do is we would put our stop loss just beneath the support. And for this example, I'll use the candle most close to the breakout. So I would put my stop loss here at 21.34. And that is our entry, stop, and target for this particular W reversal breakout trade. What we can then do is on TradingView, we can set our entry, stops, and targets to see what our risk reward would be. Now, typically, we want to see 3-to-1 risk reward trades or better. We take 2-to-1s, but we want to see 3-to-1s because that will enable us to have our winners always cover our losers. We can lose a lot and still be profitable with a 3-to-1 risk reward ratio. So we can see we're risking 8.5% on this trade to make 30.9%. That is over 3-to-1. This is a very good trade. And you can see how it did actually play out, right? What you can actually do is you can use this replay, and you can see that you have the trade set. Then you can hit the replay and see how it does actually work out in real time. Price breaks out from the W neckline, hits the target, you're out. Your stop market order or your stop limit order as your profit target gets hit, you're out of the trade. This is a winner. Congratulations. All right, so that is one example of a W chart pattern trade. Let's look at another chart and find another example. So with Polkadot, we have this ascending triangle. How we would actually go about taking the trade. We have our entry here at 38.40. The high is 38.77. So you can put it slightly or one tick above the high. Right, we'll put it at 38.77. Whatever. We'll take the entry at the local high of this candle wick. So we're saying when price gets back to that level, we want to be entered. We want to take our entry out of this ascending bullish triangle. And then we put our stop loss underneath of support. So we look to the left and we identify support. I can see we do have this one level here. This does actually look pretty good. So we can put our stop loss just beneath of this support down here. We can see we do have this one wick extreme, but nonetheless, this is a good level for a stop loss. If we get stopped out, we'll be okay. And then for our profit target, I'll go to a daily, and then we're going to have to look to the left and identify where a good place to take profit is. Now there are many ways to find profit targets. You can use price action like I do. You can use Fibonacci extensions, another method I use. There's 1,000 ways to skin the cat. So for this example, we can see that we do have this wick. And we can see that this wick was used quite a few times, right? It was used once here. It was used again over here. And this one pierced it, but nonetheless, it came into the level. So $46.89 would be your first profit target. Now with Polkadot, I expect this to make new all-time highs. So I would maybe de-risk and move my stop loss up. I wouldn't look to sell my entire position because I think this is going to make new all-time highs. But nonetheless, we can scout out the trade. And we can see that for our risk reward, or we're risking 17% to make 21%. So not an ideal risk reward trade, but like I said, I think this is going to make new all-time highs. So what we can do is we can take the fib and put extension levels on the chart. And let's say we wanted to ride it to the first extension level at $60, the 0.27 extension. That would put us to make 55%, only risking 17%. That's over a 3-to-1 now. Okay, so this is a momentum trade. You want to trade into momentum, basically. That's what the ascending triangle is. You're trading with momentum with the trend to capture the meat of the trend higher. This is what we do all day long here at Crypto Empire, and we've been crushing it this bull market. So that is another example for a trade. Okay, so let's find an example that's already played out on Polkadot. And I'll use this price action over here. I'll drop it down to a 4-hour. So for DOT, let's use right here as the example. This looks really good. So we can go ahead and use the replay to take all this out. And then over here, we can see that we do have this drop and then this consolidation. You can call this a demand zone, but we have this huge bullish engulfing candle out right here. So this tells me that there's probably some leftover orders. Buyers want to step back in if price gets back down to this 33.50 level. So what we would do is we would mark that on the chart as a demand zone, like so. And then we would take the fib from the high to the low. And we can see that the golden pocket actually works perfectly in confluence with this demand zone. So what we would say for this particular swing trade is we would say when price gets back down to the demand zone, we're going to go ahead and we're going to take our entry right at the 61.8 at $33.29. We would then identify the place to put our stop loss, and we would just put it, for this kind of trade, we would put it right underneath of the support. So I see how these wicks are touching this area over here. So what I would do is I would just put the stop loss just beneath these wicks over here, slightly to the left, right? And then for the profit target, if we're going to be risking 6%, we want at least 18% in the profit for a 3-to-1. And really, we can look over here and see where these wicks are coming to. So this actually aligns perfectly with this previous support. So I like this as a profit target over here at 39.53. That's a perfect 3-to-1 risk reward trade. And then we can see how the trade actually did play out in real time. Price starts to move. We have our order set down here at 33.29. Price came, we're triggered. All right, triggered again, stop losses hit. You guys get the point. We were in and out of the trade, and we did make money with that one because our profit target was actually hit. Right, we got triggered here. Price pumped up and hit the target. We're out. Triggered over a period of about a day or so. Right, so this is a swing trade right there. That's another one on Polkadot. And now let's give another example. So for our last example, let's take a look at Harmony 1. So Harmony 1, first of all, we have the W reversal at the bottom, but we already gave one of those examples. I want to give a different kind of example, but the W worked out perfectly. So we can see, first, step one, we identify the trend. So we're making higher highs, higher lows, clearly an uptrend here on Harmony 1. We had the W reversal signal. We know we're in an uptrend, so we look to take longs. We don't want to trade against the trend. Next, we look for an area of resistance, and we can see right here how these candle wicks, something was there. Something was stopping the price. Sellers were stepping in, pushing the price down, right? And we can then look to the left, and we can see that this level was used here. It was used here, used here as support, used here as resistance. So clearly Harmony 1 here at this level, 11-12 cents. It's a critical support resistance flip. And we also have the uptrend with beautiful ascending price action. Consistently higher highs and higher lows. So this is the ascending triangle that we absolutely love and we look for. Ascending price action, we get to the horizontal resistance, rejected 1, 2, 3, 4, right? We break above, then we retest support again before we have the real breakout. So for this example, you see the ascending triangle. Let's go on replay. So you see the ascending triangle formed. You know you want to take the long. How do you actually go about taking the entry stops and the targets? Again, we'll go over it. So if you wanted to take the trade right at the breakout level, that's perfectly fine. If you want to take it at the highest wick, that's also another opportunity, another way of doing things. There's no wrong way to do it. There's no wrong way to trade. But for this example, I mean, this is obvious support down here. So you would put the stop beneath support right here at about 9 cents. And then for the profit targets, you would look to the left, and you can see how, I mean, really you can put it where these candle bodies close. That works perfectly fine. I like that a lot for the profit target. What I'm looking at is I see how these candle bodies closed and opened here and how these wicks go right into the area. So that tells me that's a good level to take profit. So then we can measure out the trade, how it does work in terms of risk reward. So we would put the entry at 12.5 cents, the stop loss at 9.3 cents, and then the target up here at 17.6 cents. We're risking 25% to make 40%. Not optimal, but it looks like a very high probability trade. So we decide, yeah, we want to take it. By the way, if we wanted to actually place the trade, we would go in Binance. We would search 1 USDT, right? So this is the 1 as the base currency, USDT is the quote currency. We have our entry at 12.5 cents. So you would put, we would want a limit order. We would put the price at 0.125, the amount we wanted to buy. Say we wanted to buy $1,000 worth of one. That would cost $125 at that level. Then we would go ahead and we would hit buy one, right? And then we would put stop limit or stop market orders. Here in the Binance Spot Exchange, we can only use stop limit orders. So for the trigger price, we would put for the stop loss 9.3 cents, 0.93, and we want to get filled at the limit price of 0.93. So that would be our order, and again, we wanted to sell that 1,001 worth $125. So that would be our stop loss. We would want to be on sell, of course, not on buy. Always make sure you clarify that. So again, 0.093. That's the trigger price, and then we want to get filled at 9.3 cents for 1,000 Harmony 1. So that would be the stop loss. You would hit sell, and then for the take profit at 17.6 cents, same exact thing. Your trigger price, which is the stop, 0.176, where you want to get filled. That's the limit. Again, 0.176, and you would sell one for $176, making a profit on the trade. And that is how it works. We can play it, see how it actually works in real time, right? We get triggered, our profit target gets smashed, we make money, we're very happy. So that is how you go about trading. This is obviously a very beginner focused video, but I hope that it did help you out. Those were some examples. Now, again, the best exchanges, the links are down in the description below. Go ahead and use Coinbase if you're a beginner. If you want good altcoin selection, you got Binance and KuCoin, FTX as well. All of the links are down in the description for you to use. And then let's summarize everything up. Thank you for sticking with me until the end. Hope you got a ton of value out of this. Remember, crypto is high risk, high reward. Technical analysis is very subjective and it doesn't work 100% of the time. So don't always rely on technicals, but you need to get the skill of technical analysis down pat. Dollar cost averaging is a foolproof way of making money in crypto. You can make it big with dollar cost averaging. I know people who have made millions of dollars just by buying over the years. Buying. They set their recurring buy, set and forget, and now they're very happy they made that decision. So crypto, we're very early. This asset class is brand new. If you dollar cost average now, not financial advice, but you should be all right for the future. Remember, I'm not a financial advisor. No part of this video is financial advice. Please like, comment, and subscribe if you did enjoy the video. So this was a full beginner course on how to go about trading in the cryptocurrency markets. I showed you everything from how to use the exchanges, the best exchanges, what is cryptocurrency, what are stable coins, what are altcoins, all the different order types, different chart patterns, candlesticks. I hope that you enjoyed it. I hope that you did soak up the knowledge, and now it's on you to apply it, because now you can hold your own. But the only way to turn pro is by putting in the time, putting in the skin in the game. So if you have any questions, leave them in the comment section down below, or you can join the free Telegram group. Link is down in the description below. Again, I hope that you enjoyed this video. I hope you got a ton of value from it. If you did, be sure to let me know by commenting, liking the video. If you're not already subscribed, definitely go ahead and subscribe to Crypto Empire right now and turn on all bell notifications so you don't miss any future videos. Also, share this one with your friends if you think your friends might get value from it as well. And my name is Connor from Crypto Empire, and I will see you in the next video.